Welcome back to Market Brief After Hours. It is Monday, and while the calendars might say it's the start of the week, the markets are acting like we're in the middle of a geopolitical thriller.
It certainly feels that way. It's been a chaotic start, to say the least. Even though the U.S. markets were closed today for Martin Luther King Jr. Day, the rest of the world didn't take the day off. In fact, they were busy reacting to headlines coming out of the States regarding trade.
That's right. It seems like the narrative has shifted aggressively back to tariffs and territory. We're seeing a sea of red across Europe and Asia, but then you look at commodities, and they are absolutely skyrocketing.
It's a classic flight to safety, but with a specific trigger. The headline grabbing everyone's attention is the renewed tension over Greenland. President Trump is back in the news cycle targeting Greenland, and the threat of escalating tariffs on European nations has rattled investors. It's not just political posturing anymore. The markets are pricing in real economic friction.
Let's dive into the numbers, because the damage in Europe was quite specific. It wasn't a blanket sell-off. It was targeted.
Exactly. Let's start with the UK. The FTSE 100 index closed at 10,195.35. That is a decline of 39.94 points, or 0.39%. Now, compared to the continent, that might look mild, but the sentiment there is heavy. The concern is specifically about U.S. tariffs targeting British goods linked to this Greenland dispute.
But when you look across the channel to France, the picture gets much uglier.
Much uglier. France's CAC 40 index fell sharply. We are talking about a drop of 160 points, or 1.94%, closing at 8,099 points. This is where the sector specificities come into play. France is the hub of luxury goods. When you hear tariffs, you sell luxury. Brands like LVMH are highly sensitive to international trade policy, and they dragged the index down significantly.
And Germany wasn't spared either.
No, they weren't. The German DAX index decreased by 338 points, or 1.33%, closing at 24,960. While France was hit on luxury, Germany was hit on autos. Investors are terrified of escalating tariffs on German cars, which is obviously a critical export industry for them.
It seems like the geopolitical uncertainty just weighed on everyone. The pan-European stock 600 retreated by 1.19%. Italy's FTSE MIB dropped 1.34% to 45,188, and the Swiss SMI fell 1.02%. It was a rough day across the board.
And that sentiment started in Asia. Japan's Nikkei 225 lost 0.65% to close at 53,583.57, which marks its third consecutive day of declines. Hong Kong's Hang Seng tumbled 1.07%.
We did get some economic data out of China as well.
We did. Fourth quarter GDP growth in China slowed to a three-year low of 4.5%. Now, they met their full-year targets, but a slowdown to that level is definitely playing into the global growth fears. However, there was one major outlier in Asia.
South Korea.
South Korea defied everything. The Kospi surged 1.32% to 4,904.66. It was bolstered by her record-breaking performance in the automotive sector, specifically Hyundai, but we can touch on that in the Market Movers segment.
Before we get to the technicals and the stocks, we have to talk about inflation. We got some fresh data from the Eurozone today.
Finally, some good news, depending on how you look at it. Inflation across the Eurozone cooled more than anticipated in December. The annual rate dropped to 1.9% from 2.1% the previous month. That is a significant decline from the 2.4% recorded a year earlier.
That's actually below the target, isn't it?
It is. It reflects a broader disinflationary trend. In the wider European Union, the rate fell to 2.3%. Energy prices were a big drag, subtracting 0.18 percentage points. But the regional differences are wild. Cyprus is at 0.1% inflation. France is at 0.7%. Meanwhile, Romania is still dealing with high inflation at 8.6%.
So equities are down, inflation is cooling, and geopolitical tension is rising. That sounds like a perfect recipe for precious metals.
It is the perfect storm. Gold and silver didn't just go up, they hit historic peaks. Investors are running for cover. U.S. gold futures for February delivery climbed 1.71% to reach $4,674.20 per ounce. Spot gold hit $4,668.14.
And silver?
Silver was even more aggressive. March futures soared 5.06% to $93.03 per ounce. Later in the session, silver closed at $94.31, up 4.66%. Analysts are saying this is underpinned by expectations of falling real rates and central banks diversifying their reserves. It's a massive flight to quality.
It's incredible to see those numbers. We are going to take a very short break. When we come back, we are going to open up the charts and look at the Forex markets, specifically the moving averages that are dictating these trends, and we'll look at the individual stocks that made big moves today. Stay with us. Welcome back to Market Brief After Hours. We've covered the broad market retreat and the surge in commodities. Now I want to get into the weeds a bit. Let's look at the Forex market. With the U.S. closed, the technicals were really driving the action today. Let's start with the euro against the dollar.
The Euro-USD had an interesting session. It closed at 1.1644, up 0.40%. It actually formed a bullish engulfing pattern, which technical traders love to see. It shows buyers defended the lower end of the range.
Where are we sitting regarding the moving averages? I know those are critical for determining the long-term trend.
Right now, the pair is sandwiched. It's positioned below the 50-day moving average at 1.1655 and the 100-day at 1.1663. Those are your immediate resistance levels. However, and this is key, the 200-day moving average at 1.1586 is providing a solid foundation. As long as we stay above that 200-day line, the broader trend has support.
So we need a break above 1.1663 to really confirm a recovery?
Exactly. Until then, the bias is shifting upward, but we need that confirmation.
Let's move to the British pound. GBP USD seemed to have a stronger day.
Much stronger. It finished at 1.3428, up 0.36%, ending near the session highs. What's impressive here is that it reclaimed all the key moving averages. It broke back above the 50-day SMA at 1.3328, the 100-day at 1.3365, and crucially, the 200-day at 1.3404.
Holding above that 200-day average seems vital for the pound right now.
It is the line in the sand. If buyers can keep the price above 1.3404, the outlook is constructive. We'd be looking at a target move toward 1.3500.
What about the Aussie dollar? That usually acts as a proxy for risk sentiment.
AUD-USD maintained its bullish momentum, closing at 0.6714, up 0.53%. This chart is beautiful if you're a bull. You have a perfect alignment of moving averages trending higher. The 50-day is at 0.6612, the 100-day at 0.6586, and the 200-day at 0.6530.
So it's making higher highs and higher lows.
Precisely. The session low of 0.6687 is immediate support. As long as that holds, the technical bias is bullish, with eyes on the previous swing high of 0.6777.
And finally, let's look at our neighbors to the north, the Canadian dollar.
The USD CAD is under pressure. It settled at 1.3867, down 0.33%. It faced rejection at higher levels and is currently trading below the 50-day SMA at 1.3898. However, it is still above the 100-day at 1.3805 and the 200-day at 1.3837.
We also saw some inflation data from Canada, right?
Yes, consumer price growth there accelerated to 2.4% in December, which was hotter than the 2.2% forecast. That complicates things for their central bank. Technically, the pair has a short-term bearish bias unless it can reclaim that 50-day average at 1.3898.
Let's shift gears to the specific market movers. We mentioned South Korea earlier. What happened with Hyundai?
That was the story of the day in Asia. Hyundai shares jumped a massive 17.92% to reach a record high. They completely bucked the regional downturn. It was driven by record demand. When the rest of the auto sector is worrying about tariffs, Hyundai is just selling cars.
On the flip side, we talked about the luxury sector in France.
LVMH, the giant. Shares tumbled 4.69%. This is a direct reaction to the threat of U.S. trade barriers. When you target European goods, LVMH is the first target on the board for traders to sell.
And the German automakers?
BMW slid 3.74%. It led the broader decline in the European automotive sector. Again, trade concerns are the primary driver here.
Moving to crypto. Bitcoin has been hovering near highs, but we saw a dip today. Was it panic selling?
It wasn't panic, more of a reset. Bitcoin saw a sharp pullback during the Asian session, dropping from $95,300 down to $91,800. That's about a 3.7% drop. It triggered about $233 million in long liquidations, which flushes out the excess leverage. But the price stabilized around the $93,000 area. The sentiment cooled a bit, but this looks like a classic buy-the-dip response rather than a structural breakdown.
And just a quick note on the metals again, because the technicals there are fascinating.
Briefly, gold at $4,671 is in uncharted territory. The moving averages are miles below. The 50-day is way down at 43.01. There is no resistance because price has never been here. And silver at $94.31 is trading significantly above its 50-day average of 65.34. That is an explosive breakout.
It really puts into perspective how extreme the move has been.
Absolutely. As we look at the week ahead, the narrative is going to be dominated by this intersection of trade policy and inflation. Investors are going to be hyper-focused on any protectionist rhetoric from the U.S.
It is going to be a fascinating week to watch. We will be here to break it all down. If you find this useful, please follow Market Brief After Hours. We appreciate you tuning in.